Hey everyone, welcome back to In Her Wallet podcast. I'm Sophia, your host, a Vancouver based financial educator and founder of In Her Wallet. Today we're diving into something that's been making a lot of headlines lately. It's tariffs and the current state of the economy. Between market dips, sticky inflation, and global rising tensions, it's no wonder that even experienced investors are feeling a bit uneasy right now. So I brought in someone today who can help us make sense of it all. Seth Allen is a senior portfolio manager and founder of Cadence Financial Group at Raymond James. He brings over 25 years of experience to the table. And in this episode, we talk about what's really going on with the economy, how global trade tensions can impact everyday Canadians, both consumers and investors, and what you should and shouldn't really stress about today. So, if you've ever felt overwhelmed by the headlines or just unsure what to do with your money when markets get shaky, this episode is for you. Let's dive in. Seth, welcome to In Her Wallet podcast. I'm so glad to have you here.
Thank you, Sophia, for having me.
Before we dive in the conversation about tariffs and what's happening with the economy, can you share a few things about yourself and what you do? I know our audience will appreciate getting to know who's behind the insights.
Yeah. So my name is Seth Allen. I'm the founder and senior partner at Cadence Financial Group at Raymond James. We manage money for high net worth families and family offices. Been doing it 27 years. And I think with what we're going through recently, I can honestly say pretty much everything we've seen in one form or another when it comes to markets and different types of events like what we're going through right now.
So it's not the first time that something like this happens, obviously, in your 27-year career.
Yeah, I think that it's a different storyline. I started just before the dot-com crash, and then we had September 11th, we had the credit crisis, we had the debt crisis in 2011, the Greek crisis, I think it was 2013, 2014, Trump 1.0 in 2016, the pandemics, crazy interest rate moves 2022, and now we have Trump/tariffs 2.0.
So you've had your
It's
fair share of experiences with the market volatility.
I suppose so. And I don't know if that's a good thing or makes me wonder how we get through it all, but we do.
I'm very excited to hear your thoughts and insights today as we're going to be talking about what's happening currently in the economy. So let's start from the top. What's actually going on right now? Can you give us a quick sort of plain language summary of the current climate?
Yeah, I think the economy, there's from the Canadian perspective and then there's the world perspective. And I think, from more important part, the world perspective is the US economy and what's happening there and how that's impacting the rest of the world economies. Obviously, this whole thing with trade and tariffs, it's been front and center. It's sort of overridden something that, doesn't get talked about as much is that the world economy has been doing quite well up until recently. I don't think that it's doing poorly. I just think that it might be a little bit on pause as everybody tries to figure out what all of this tariff or regulation that's being put on various countries means when it comes to economic growth. I think in Canada, it's a little bit different situation, which is a little bit more personal for us. We've been trading close to a recession, I think, for the last couple of years. Our growth has been anemic, as they say. There's various reasons for it. And I think that we have an election coming up in a few weeks that's going to let us decide as Canadians how we want to grow out of this economic malaise that we've been in for the last 12 months, 18 months.
Seth, you mentioned the word tariffs, and I just want to zone in on that. Obviously, tariffs have been making the headlines for the past several months. Can you explain to us what do tariffs mean in general? What is a tariff? And why do governments use tariffs?
So first off, obviously, what we've heard most about is tariffs from the American perspective, right? You have the U.S. president talking about countries treating the United States unfairly, what have you. Reality is every country in the world has them to some degree. And I say to some degree because tariffs are used for various reasons as a form of revenue collection. So some countries, for example, don't have much in the way of personal income tax. So the way they collect revenue is through tariffs or through sales tax, VAT tax, GST, things like that. In terms of why does it go beyond just what we've had in the past to what we're seeing today? I think that what the United States is trying to do is trying to correct some trade inequities, which I do think exist. I just think that perhaps the approach is taking a sledgehammer versus a surgical knife to dealing with some issues that Canada's also faced. Industries that we want to protect. We want to protect our steel industry, automotive industry. We want to protect our dairy industry. And so we'll have, both direct and indirect tariffs, or basically taxes to foreigners to protect those industries. And again, there's trade-offs to those things, right? It's not a free lunch, as one would think. There's obviously a cost to it, but the flip end of it, there's also the benefit. Countries do this for their own benefit and for their peoples.
If we're talking about tariffs from the perspective of an average person, how do they affect someone like you and me? And how does it affect the things we buy?
I think that's a great question, because it's that cost benefit analysis, really, right? Is that on the one hand, the tariffs are done with the intent to benefit the country and the people, but there's a cost to it, right? And that cost, it really depends on what the tariff rates are. And think of tariffs like the GST, right? We have GST of 5%. Imagine if GST was 40%. That would basically mean that things are going to cost more for us that we bring into the country. So if you like nice handbags, for example, if you were in the United States, it's going to cost you more.
Mm-hmm.
And the reason for that is no different than if we were to raise the GST from 5% to 20%, that's going to get passed on to the consumer. And yes, some of it does get absorbed by the companies that sell the products, but for the most part, the consumer ends up paying. And again, it's not necessarily a bad thing, because it may allow producers of certain goods and services in our own country to compete better, right? And we may choose to buy Canadian. I'm not so sure if it would be on handbags per se, but
Yes.
perhaps other products would make more sense for us to buy in Canada versus abroad.
Seth, as Canadians, how do tariffs impact us right now? Do we need to be concerned about the US tariffs and the current volatility that is happening in global markets today?
Yeah, I think the answer is yes and no. I think, yes, we need to be concerned about the uncertainty, right? A lot of this volatility is really driven by uncertainty. If we knew that, okay, it's going to be a 10% tax essentially, or a tariff going forward, it would allow us to plan for the future and figure out how, we're going to make our buying decisions, or companies are going to make their investment decisions. I think the trouble we have right now is not only do we have uncertainty, but people also forget we also do have a free trade agreement with the United States. And for a while there, that seemed like that's been upended. Now, again, those things have been walked back, and, that trade agreement's being honored. But I think the biggest thing right now is the uncertainty. That being said, that also presents the opportunity, if you look beyond just what's going on right now and look out a year or 2 or 3 or 4 years down the road, it can also present some opportunities.
If we're buying things that are not directly coming from the US here in Canada, can those things rise in price as well somehow?
Not to sound like the weather person, but it's a yes or no answer to that. Depends. One of the silver lines to all this is things could actually be cheaper for us Canadians. So if you think about this for a second, if China is being hit with a big tax by the Americans on products, they still have to sell their products somewhere. So that means places like Canada and Europe, in theory, could get things a lot cheaper. But, the flip end of it is that because our supply chains and our trade is global and interconnected, when you sort of kind of put one kink in that trade fence, it could have unintended consequences with other trading partners, which indirectly could affect us. But I think in the short run, there could be a net benefit for Canadians that are looking to import things from Europe or from China that essentially they need to sell into our markets, because the American markets have gotten more expensive.
You mentioned that we do not have tariffs that US imposes on Canada right now, but in the event that Trump does go back and say, actually, I do want to put tariffs on Canada, what are some of the industries that would be impacted the most? Maybe a few tangible examples that you can give us there so people know what's, the first thing that will be impacted.
Just to clarify, again, this is part of the problem right now, is there's even this, what we're talking about today could be invalid or not relevant by the time that this comes out. Yeah, exactly, right? Because of how many back and forth is going on. So to be clear right now, yes, the U.S., Canada, Mexico free trade agreement is being honored, but there's still a 10% tariff on anything that's not included in the treaty. And there's also a special tariff that's been put on steel, for example, and aluminum. And there's question marks around automobiles. So yes, we have a free trade agreement, but it's kind of messy and uncertain as to, is it just that it's being honored and tariffs on other stuff, or is it going to be one tariff on everything?
Totally makes sense. What are the industries or products that might get affected the most for us Canadians?
So I think the first line of things that we need to be thinking about that are going to be affected is forestry, aluminum, and auto parts. To some degree, energy, but unless the U.S. wants to have a substantial rise in energy costs, the gas pumps, I think that's going to be muted. And so when you look at it from a Canadian perspective, the numbers sound big, and yes, it's going to affect certain industries, like I mentioned, but it's also like not going to affect everything that we have in Canada. I think that from an investment standpoint, if you don't own investments in those sectors, at least the first line of this trade war, trade battle, or whatever you want to call it, you're not going to be affected by as much.
You did mention automobiles, that they are sort of an uncertain spot in the free trade agreement right now. So does that mean now
Yeah.
is a good time to buy a car or sell a car, or is it better to wait? If someone is planning to make that big purchase, what should the timeline look for them?
Yeah. Again, I feel like I'm giving the weather report here because it depends, right? I think quite possibly if you're buying an automobile made in Europe, again, there could be some special pricing. I think that if you have a used car, for example, you may get more for it than what you may have done just 3 months ago.
Sort of similar like it
And
was
I,
during COVID when people were.
yes, to some degree, I think as far as a car that's made in the United States, these things are changing daily, hourly. In theory, it's going to be more expensive. But again, what could be cheaper is that car that's made over in South Korea or that's made in Germany could actually end up being cheaper for you. So I think that cars in general, it's not that all of them are going to become more expensive. It's just certain ones may become more expensive and other ones become a better deal to purchase.
Seth, let's talk about investing. Obviously, markets have been very volatile in the last few weeks. There's a lot of red in the market. What does this volatility mean for Canadian investors? If someone is a DIY investor and they're investing in things like ETFs and individual stocks or using a robo-advisory platform like Wealthsimple, what are the things they should look out for when it comes to tariffs and global policies?
As much as we've seen a lot of red, we've also seen a lot of green, particularly in the last 2 days. A couple of tweets, and we can see a lot of green or we can see a lot of red. I think as an investor, particularly a do-it-yourself investor, I think you need to take a step back. And I use a car analogy that you don't want to spend too much time looking at a rear view mirror or looking at the drivers beside you as you're driving down the road, because what's going to happen is you're going to end up in an accident regardless. And so, when it comes to looking at this tariff situation, if you're using something like a robo-advisor, I think that's a great test to see if it actually works. Because that's what a robo-advisor is supposed to do. You're not supposed to be overriding what that artificial intelligence robo-advisor is doing in your portfolio. So if it's not working for you, maybe you need to take a second, think about whether you should be using it or not. I think if you're buying ETFs, it is probably a safer way as a do-it-yourself investor than buying individual stocks. Understanding that you'd want to own Coca-Cola right now over Pepsi takes a lot more than just simply looking at these companies' share prices. Coca-Cola is less affected by tariffs and are benefiting from a lower US dollar than Pepsi that's more affected by tariffs, right? And so with an ETF, you can kind of own certain sectors or certain themes without having to necessarily get into each individual company, understand, or FedEx versus Uber, right? Why would you own Uber versus FedEx right now from a tariff perspective? I think the other thing as a do-it-yourself investor, again, I go back to the car analogy, and I'm sure you talk about it in social media in general, is this comparing or looking at what person beside me is doing, what's the market doing? I think the reality is you have to look at what you need to be doing, right? And what that means is that you need to sort of pay attention to what's going on in the marketplace, but really focus on what you're trying to achieve. And if your long investment objectives or your goals or your outcomes are 10, 20, 30 years out, these are opportunities, right? Like we go into grocery stores or you see a sale on Boxing Day and everybody gets excited about it and they want to buy more of that particular item. Yet we see that happen with great companies and we get scared and we wonder is Microsoft going to zero? Is Royal Bank going to be around? And yet, these could be very good buying opportunities to them. And again, it's not that you want to blindly just step in and buy just because it's down. But I think when you feel that fear and you feel that sickness in your stomach, that's where you need to really be looking ahead, not behind and not beside you, looking ahead at the opportunities to either buy some ETFs or, if you have done the research, buy some individual holdings. Warren Buffett, who is a well-known investor, did that line, be greedy when others are fearful. This is a time where you need to start being, well, the way from Cadence perspective is we agree with that, but do so cautiously. And I think this is a time to be thinking about that, particularly if you're a younger investor.
I totally agree with you, Seth. I always tell my sister and my girlfriends who I speak about investing with, I say when there is a sale at Zara or Aritzia or at Whole Trend Free, we all get excited and we want to go and buy something that we've been waiting for. Yet when the markets fall, we get scared, like you mentioned.
The reality is, even us as professionals do get scared a bit.
Yeah.
Right? It's normal. That's okay. And I think anybody who says, oh, I'm not scared, buy, everything's going to be good. I think those are the ones you may want to be cautious of listening to their advice. I think, it's good to have a certain amount of fear in you, but it's good to recognize the opportunity in that fear, I guess is the way I put it. So when my stomach kind of gets a little bit twisted and I come home from work and my sweet wife asks me how my day is and I don't really want to talk about it, that's where I actually have trained myself to start thinking, okay, I got to start thinking about opportunity here. Feeling okay, and it's a good thing.
I really like how you mentioned that when things fall in price, you don't just go and blindsidely buy everything that there is. You need to be very smart and calculated in that approach. And you did throw out a few examples there of why someone should buy Coca-Cola over Pepsi. And then you had an example of FedEx and Uber. Can you give us a few more examples like that and explain why you're picking one over the other in current environment?
Maybe just taking a step back for a second. I mean, there's two types of companies you want to buy. I call it the ones you want to rent and the ones you want to own. Ones you want to rent are, gold stocks, for example, or oil stocks. They have their moments. They're great to own for a while, but you don't want to have those long-term because they're not really great from a shareholder standpoint from a long-term rate of return perspective. There's other companies like a Microsoft or an Apple that they may have their ups and downs, but they have wide moats and their businesses, like, I call Apple the heroine of the tech business, right? Once you're on it in your ecosystem, not going to be leaving it anytime soon, right? And yes, they're going to get affected by tariffs, and yes, the share price is going to jostle around, but I think that, that's something that has a very good business. So I think that's the first thing you got to do. You got to figure out what bucket you want to be in. So if you feel right now is a good time to own gold and some commodities, then what you want to do is you want to find the best of those, or you buy an ETF, right? If you feel that you want to own some good, I call it wide moat, long-term ownership of an Apple, Microsoft, Royal Bank, or something like that, then what you need to do is step back and look at it from not just a share price, like how much did it come down, but like what's the valuation? And, valuation is a funny thing. What you and I might pay for something today is very different than what somebody would have paid for it 30 years ago. My generation was Beanie Babies, right? People paid a lot of things today. They don't pay that much, right? And so you really need to kind of figure that one part out. But I think the second part is you need, frankly, do a little bit of reading to see, like, for those that have done any kind of business class, a SWOT analysis or entrepreneur, I often suggest you do a SWOT analysis: strengths, weaknesses, opportunity, threats. I think you really need to do that on a Coca-Cola versus Pepsi. And if you go through some of their presentations and what have you, then you can see, okay, great. Coca-Cola is not as affected by tariffs as Pepsi is.
Why is that?
It's because of where they do the bottling of the making of the product. Yeah. So more of it's made in the United States for Coca-Cola for what's sold in the United States, more of it's made in the US than is Pepsi. The other thing is Coca-Cola, a lot of their revenue also for what they do have overseas is in foreign exchange. So when the US dollar goes down,
it's on sale.
They make more money on the foreign exchange. But again, taking a step back from that, how do we get to maybe Coca-Cola versus Pepsi? You might say, geez, I'm really nervous right now, but I do want to own some things that have sold off. Consumer staples, which those two fall into, would be a category that, is considered a safe category when things are a little bit uneasy. And so if you didn't the ETF, then you start looking at consumer staple stocks, then you start kind of going through looking at, okay, well, where are they sourcing their inputs, where are they selling their product, and how much is that going to be affected by tariffs? I mean, the problem with all this, though, is if this whole tariff thing kind of goes like it did in 2018, it could be that if you bought Coca-Cola today, you're paying, a nosebleed valuation for it. And if the tariff thing kind of settles down, Pepsi could look like the real steal, right?
Mm-hmm.
And that's just sometimes when it comes to picking individual stocks, and sometimes I say pick the ETF, it's easier. But that's also why if you're going to do it yourself, you have to kind of keep an eye on these things. And again, I go back to Coca-Cola, Pepsi. I would put Coca-Cola in the category, this is a core holding you want to have for a lifetime. It's just how much do you want to own? So maybe what you do is you set a price target, an upside target, a downside target, so that if it goes up to your target price,
Yep.
you sell half of it. If it goes down to here, you sell half, but you still maintain a position and you reassess if it's not working out, in terms of if you've had to sell some, right?
That's a very
Okay.
good example. Thank you so much. What caught my attention as well is how you said there are companies that you want to rent and there are companies that you want to own.
Absolutely.
When we're looking at a portfolio, what should be the percentage of companies that I want to rent and what should be the percentage of companies that I want to own?
Well, I think that depends on how much time you want to spend on your portfolio.
Type
Royal,
who invests and
yeah,
forgets. I don't go and
yeah.
check my portfolio every day.
So you would definitely want to have more to own. The problem with renting is I'll use commodity stocks as an example. There are times where you can make a phenomenal amount of money in oil and gold and things like that. The problem is those prices are in large part driven by the underlying commodity. So if gold were to go from the 3,000 or 3,300 is at right now down to 1,000, gold stocks are going down. There's no ifs, ands, or right. And if you're busy or you're traveling and you're just not paying attention, those share prices are going to drop rather dramatically. A Microsoft, I can't really think of something. It's not a commodity. Again, it's something that has high stickiness business. It's subscription based. I can't think of anything that would cause that stock to drop 80%. It's possible. Everything's possible. But, I think it depends on how much time you want to spend on the portfolio. And some people love the renters. They love, they love the trading. They love trying to figure out, is it the AI stuff that's going to hit now, or is it the marijuana sector, or is it the crypto sector? To me, those are all rents. The ownership stuff, it's more sustainable. And I suppose in another way too, it's easier to make a decision to buy more if it's down, because if it's down, it's probably something like what's going on right now.
Mm-hmm.
And if you think 5 or 10 years out, is Royal Bank going to be higher 10 years out than it is today? Most likely. Is ABC gold stock going to be the same? I honestly can't say. Depends on gold prices.
Yes. Seth, we often hear advice that's targeted towards US investors mainly. For us as Canadians, what are the things that we should keep in mind when global movements like this happen? And should we be looking at something different than US investors?
And the reason why we look at the US a lot is because reality is the US is the largest economy in the world, and they're also the largest stock market, and they have the most amount of wealth in the world. Canada, as much as I love my country, on the world scene, like we're insignificant from an economic standpoint. That being said, as a Canadian, at the end of the day, if we're going to stay in this country, it does matter ultimately what dollars we have to spend, right? In Canadian dollars. And so I think we need to think about, one of the big things we need to think about is foreign exchange, right? One of the better performing assets this year has been the Canadian dollar. If you would have asked me that back in January, I think we were all kind of the line, the Canadian dollar was going lower. And then the trade stuff came up and we're like, oh my gosh, 60-cent Canadian dollar. But Canadian dollar has done the opposite. And so I think that's one thing you definitely need to pay attention to from a Canadian perspective. I think the other thing too is that in Canada, our investment landscape has become more and more and more narrow just because of, I think, some of the policies that we've had that, some would say they're good policies, others would disagree, but the outcome of that has been a more narrow capital markets to invest in. And so I think that as a Canadian investor, I'd be looking to see kind of what happens over the next couple of months, particularly in terms of are we have an opportunity to, build out those markets more in a way that allows us to invest here in Canada versus having to go to the US? I mean, you think of healthcare, for example, we don't have any healthcare companies that are public really in Canada. To invest in healthcare, we really have to go down to the US or Europe.
I own stock called Well Health Corp. They're
Mhm.
actually
Yeah.
Vancouver based, but yeah, that's the only one I can think of.
Yeah. And when you think of the US, I mean, there's hundreds of healthcare companies, right? You can invest in. Then you got Europe. But then what you're dealing with, part of the point I was making is that let's just say that you make a great investment, you make 10% on a healthcare company in the United States, but the currency moves 15%, which it could. It has done that over a 12 to 18-month period. All of a sudden you haven't made any money, you've lost money.
Mm-hmm.
And so I think that's one part of this that people need to realize. It's a bigger risk right now is where does the foreign exchange end up from an investor standpoint?
That's a very good point. Thanks for highlighting that, Seth. So for people who have money invested in the stock market, who have a portfolio, do you suggest they just stay the course or should they do something different?
I think if you haven't done anything yet, yes, you should see the course. I think though that you really need to use this as an opportunity to go, do I have the right investment strategy? Do I have too many rentables? Do I have enough long-term holds, core holdings? Am I way too overweighted in one sector? Did I get too excited about crypto and not thinking enough about boring old Coca-Cola? I would use this opportunity to reflect. If you did amazingly sit all in cash, 3 weeks ago, I think that you should have already been thinking about putting some money back to work. There's two great charts that, again, and various financial firms have been sharing them and what have you, but there's the one that kind of shows the best and worst days of the market over the last 20 years. And everybody says, if I could just spot that day and what have you, well, they're all like around each other. They're all within days of each other. The worst days, best days are all like aggregated together. And if you look at if you miss, a handful of the best days of the market over the last 20 years, your return would have been zero. And so the thing I caution people about is not that you can't raise cash. I think that's a good idea sometimes. You just have to not try to think that somehow you're going to time this market in and out. And sometimes, listen, people can get lucky. Maybe some people think they have more skill with it, but over the long run, I think what happens is you set yourself up for bigger mistakes down the road. So I think the big takeaway right now is I'd be very reflective on what worked, what didn't work with your investments, and then see how you can do better. And if you're younger, this is better than a university education. At least all it's costing you is wherever you've dropped in your portfolio, versus taking all the student debt to learn the same thing. So yeah, I would use this as a great opportunity to reflect and see what you can change or keep the same.
I'll definitely make sure to have that chart that you described pop up during our conversation. My husband showed it to me as well, and it's pretty incredible.
There's two parts to the chart. If you were like the perfect market timer, if you missed the worst 10 or 20 days, your return would be, if you just stay in the market.
No one has a magic ball to figure out when these days are. So I think the best approach is to just keep the course and, as you mentioned, reflect on how your portfolio is performing. And if you recognize that there are some opportunities, improve it in that way.
By the way, if you have that magic thing for me, I'd be happy to have it too, because the reality is none of us really know. I said to somebody that I always thought the unknown risks were the tough ones, credit crisis, but this one's a known. We know what's causing this. In ways, it's tougher because it's creating more uncertainty, right?
Yeah.
And so I think that you can never really know when it's going to happen. It's like hitting a stormy weather, right? You don't know when you might have it or a flash flood. But if you're prepared for it, or, you have some things, you got a good umbrella, you got rain boots, at least you're going to get through it rather than trying to predict it, right?
Mm-hmm.
And the other thing I was just going to quickly say is absolutely avoid all the emails and all the free newsletters that are going out right now saying that they have the magic potion to answer your questions on how to figure this all out, because all they're trying to do is sell you something. And they're not accountable to you at the end of the day and your investment outcomes.
You almost answered my next question, because I was going to ask you, there's all this news headlines shooting at us from different sides about tariffs and how these billionaires are losing billions of dollars in one single day. Do you have any tips on how to stay calm and not feel overwhelmed by all these news and just, stay the course?
Yeah. If it bleeds, it leads on the various news networks. I kind of use the image, and I don't watch a lot of basketball, but I do think about this at times when there is a free throw shot to be had and basketball players line up the shot and everybody has all those horns and they're all screaming and stuff. I think that's how you kind of you just have to zone it out. And again, focus on the outcome that you're trying to get. And it's not that you can't listen to certain things, but I think that the louder it is, the less you should listen to it. And just remember, like, to get people to watch television, to get people to click on something on Facebook or Instagram, it has to be something that either gets you kind of feeling greedy or fearful or what's the answer? I need to get the answer here, right? I mean, and I think you just have to be cautious of not letting yourself go down that rabbit hole, because otherwise, it just, going back to that weather analogy, you're going to end up in a blizzard and you're not going to know which way is home. And then you're going to end up walking off a cliff or something like that. You're doing something really silly that you probably shouldn't have done. You should also think about whoever you're taking advice from or you're reading from, what accountability do they have to you? So if they're very open and very like authentic, and maybe it's a paid subscription, or maybe if you are using an advisor, there's a certain engagement, then you can kind of put a little bit higher value on that advice or that opinion. But you also have to differentiate what's advice and what's fact.
Yes.
Because all of us can look at the same thing and say the glass is half full. No, it's half empty. And some could say, no, it looks just about right.
This is a great example of how people look at the same thing in a different way. Thank you, Seth. I think we've had a great conversation so far. You've answered all of my questions, and I am confident that our audience will find this super insightful. Seth, how can my listeners connect with you and follow your work and learn more from you?
Yeah, I think there's two ways. They can go to cadencefinancial.com or on Instagram at Cadence Financial, I believe. They can sign up for the newsletters. There's no obligation. You don't have to be a client or any of that kind of stuff. You can sign up for the webinars. We're always happy to share information. The other way, the organization, which I know you're going to be involved in this fall, that's really dear to my heart, that we're really actively supporting, called Her Wealth, where it's for the financial betterment and empowerment of women. Have a look. It's called Her Wealth Summit. I know there's 60 plus speakers. You're one of them.
Yes.
There's going to be talking about various topics. And I think the goal behind that is really to provide some really useful information that you can take it away. Like there's no, well, come sign up here. We'll give you the real secret to it. No, it's like, here you go and use it as you will. And the other thing too, is all the banks, they generally have some good information. I don't mind saying that. If you go to, I think RBC, because I think they're one of the better ones. I think that they do have a lot of good complementary, pieces that they put out, both what's going on in Canada, what's going on worldwide. But I think at the end of the day, though, whatever you do take for information, just figure out how does it work for you and what you're thinking investment strategy wise, and is it going to work towards the outcomes you're looking for? Because goals are great. That's what we dream about. I have a goal to do this. Outcomes are a lot better at the end of the day. When you're like, okay, I've done this, and this, and all worked out. So.
Totally. We are actually going to be giving away a few tickets to the Her Wealth Summit that will take place in person in Vancouver this September in the next few episodes. But Seth, thank you so much for being with me today, for sharing your insights, and for doing it in such an actionable and digestible way for our audience.
Thank you so much, Sophia, for having me. Appreciate it.
Thank you for tuning into In Her Wallet. If today's episode inspired you or gave you a new perspective, it would mean so much to me if you followed us on your podcasting platform of choice, shared this episode with your friends, and left a 5-star rating and review. I want this episode to serve as a reminder that you're not alone in your financial journey. This podcast is your guide to financial success, equipping you to live your best life without sacrificing your financial future. It was Sophia with you this Wednesday, and I will see you next week.